A reliable order block trading strategy is often the missing puzzle piece for many traders using smart money concepts. This usually happens because they lack clarity on the key factors that define a high probability order block. In this video, we've laid everything out clearly and made it simple to understand, so you won't have to guess when it comes to order blocks anymore. To make it even easier, we've broken down the ideal order block trading method into 6 straightforward steps. So, if that's something you're here for, be sure to hit the like button to support the channel, subscribe if you're new, and turn on notifications. We'll see you right after the intro and disclaimer. So let's begin with step 1, which answers the question, what exactly are order blocks in trading? In this chart example, the first thing we can observe is that the market is following an upward trend. However, when we focus on this second leg of movement, you might ask, why did price decide to rally from this exact point? Looking to the left side of the chart gives us the answer. We can see a bullish order block, which served as a support zone, allowing price to push higher. This area is significant because it previously reflected strong selling interest, indicated by the presence of numerous bearish candles and heavy sell-side order flow. That's why smart money often looks to these zones to execute large buy positions where sellers previously dominated and where current seller pressure is minimal. To put it simply, bullish order blocks are made up of bearish candles and operate as support levels that drive price upward. On the flip side, we have bearish order blocks, which are formed by bullish candles. They function similarly, but in reverse, they act as resistance and push price downward. But this is just the foundation, and most traders make mistakes by not understanding the structural elements that must be in place to confirm an order block. Fortunately, we have a few simple criteria that make the validation process straightforward. The first thing to recognize is that there's no fixed number of candles required to form an order block. To illustrate this, take a look at the left side. We see an order block composed of 4 candles. Now compare that to the right side, where another order block is made up of just a single candle. Both are completely valid as order blocks. This is because the duration or number of candles doesn't define its validity. The only difference between these two bullish order blocks is the amount of time sellers maintained control. Next, let's talk about something you may have already observed, which is that when we outline our order blocks, we prefer using the candle bodies instead of the wicks. Taking the 4-candle order block as an example, it stretches from the open of the first candle to the close of the last one. The same applies to a single candle order block, measured from its opening to its closing price. For bearish order blocks, the principle stays the same. But since bearish order blocks consist of bullish candles, the opening price of the first candle will be at the bottom, and the closing price of the last candle will be at the top. Now that we understand how to properly mark an order block, let's now move into the next step, which focuses on how to determine whether an order block is actually valid. Using the same chart as earlier, we can see that this series of bearish candles formed a bullish order block, which was respected later when price retraced into it. But let's rewind to the moment right after those bearish candles had just printed. The key question here is, have these bearish candles already established a bullish order block? And the answer at that point in time would be no. That's because we haven't yet observed the market's reaction afterward. For instance, price could have simply consolidated, meaning the bearish candles wouldn't qualify as an order block. The reason is that for these candles to meet the criteria of a bullish order block, we need to witness a strong bullish move that breaks above the highest wick in the formation, which in this case is the first candle's top wick. Only once that clear break of structure happens can we confirm that these bearish candles have indeed formed a valid bullish order block. This is because, when it comes to the criteria required for these candles to qualify as a bullish order block, we must first observe a strong, impulsive bullish move that breaks through the highest wick among those bearish candles, which, in this instance, is found on the first candle. And it's only after this break in structure occurs that we can confirm the bearish candles have formed a legitimate bullish order block. To provide another illustration, take this example of 4 bearish candles that could potentially form a bullish order block. But in this case, the highest top wick belongs to the 3rd candle in the sequence. So, for this structure to be confirmed as a bullish order block, price must break through the high of that 3rd bearish candle. Now, when it comes to bearish order blocks, the same principle applies. But it works in reverse. we're instead looking for a clear break below the lowest wick among the bullish candles to validate a bearish order block. Armed with this understanding, let's now pinpoint where the next valid order block can be found within the rest of this market structure. Initially, we have a strong bullish move, followed by 2 consecutive bearish candles. These 2 bearish candles had the potential to become the next bullish order block. However, the bullish movement that followed failed to break the previous high and soon reversed, which means those candles didn't form a valid bullish order block. Looking further, we can see that the next single bearish candle did end up forming a valid order block, because its high was decisively broken during the next bullish move. Now, you might be asking why the 2 previous bearish candles weren't grouped into the same order block. The reason is the appearance of 2 bullish candles between them, which disrupted the bearish sequence. So the final key criterion for identifying valid multi-candle order blocks is that all candles must be in sequence, with no opposite-colored candles interrupting them. Now that we understand how to correctly spot and confirm an order block, the next step is identifying which order block setups offer the highest probability for successful trades. Now, let's move on to the next step, which focuses on combining order blocks with fair value gaps for high probability setups. We already understand that for an order block to be considered valid, it must cause a break of structure, specifically, a clean break above the high of the bearish candles. But when we're trying to determine whether an order block is high probability, we need to look deeper, starting with the bullish impulse that breaks the structure. Within this move, we're looking for the formation of a bullish fair value gap. Why? Because the presence of a fair value gap in that impulse shows clear buying strength, which is key if we're going to rely on it as support later. However, the most important part of this setup is where that fair value gap is formed. Ideally, it should appear within the price range of the order block itself. When this happens, we're seeing 2 overlapping PD arrays, the order block and the fair value gap, aligning in the same zone, which creates a strong area of bullish confluence. Now, let's look at another example where we have a bullish order block, and a fair value gap also forms during the move that follows. However, this time the gap forms after the price has already moved outside the range of the order block. In this scenario, the setup is considered lower probability, since the fair value gap and the order block do not overlap. That means we only have a single PD array to work with, rather than a combined zone of interest. Finally, let's break down one more example. In this final example, we observe that the impulsive bullish move fails to create any fair value gap. This lack of imbalance reflects weak buying momentum, and as a result, this would not qualify as a high probability order block. So to recap this concept, when a fair value gap forms within the same move that creates an order block, it establishes a powerful confluence between 2 PD arrays. This overlap significantly strengthens the setup, as it defines a high probability support zone, often referred to as a golden zone. However, it's critical to ensure that the fair value gap is formed within the range of the order block. If the gap appears outside that range, or fails to form at all, then the setup lacks the confluence needed and shouldn't be classified as high probability. Now let's move on to the next key principle for identifying high probability order blocks: they must be unmitigated. Take this example, we're analyzing a chart where a valid bearish order block is identified, and it's also overlapping with a bearish fair value gap. This satisfies the conditions for a high probability setup, as we now have confluence between 2 PD arrays. As price evolves, we can see that this zone is respected, acting as an effective area of resistance. At this point, you might assume it's a good idea to target the same zone again in the future, but that's where many traders go wrong. Once price revisits and reacts to an order block, it becomes mitigated. In simple terms, this means the unfilled institutional orders that were originally sitting there have now been filled. Since smart money targets order blocks specifically for those unfilled orders, there's no longer a reason for them to revisit a mitigated zone. As a result, reusing a mitigated order block will typically lead to weaker reactions, or price simply pushing straight through it. Key takeaway: right finger only use unmitigated order blocks when planning trades. Once a zone has been tapped and respected, move on and look for the next setup. This applies even if the market has only slightly tapped into the order block. As we can see in this case, it is still considered mitigated. Therefore, we should avoid using it for another setup. Another useful tip to note is that when drawing the range of an order block, the 50% mid-level is a significant point to observe. In the case of a bearish order block, the area below the 50% level is usually the most concentrated point of rejection, as this is where the majority of orders are likely placed. That said, it doesn't mean the order block is invalid if the price moves into the upper half. It simply indicates that the lower half tends to be a stronger zone, especially if the fair value gap is also located within that part of the range. For bullish order blocks, the concept is reversed. The upper half of the block is generally stronger. Still, it's important to remember that both halves of the order block remain relevant. This is just a helpful observation when structuring your setups. Now moving on to the next step, we have another key piece of criteria for identifying high probability order blocks, only using order blocks that are formed from a previous PD array. Looking at this new chart, the first thing we should immediately observe is that the market has executed a liquidity sweep from the prior swing high. We can confirm this sweep by identifying the change of character that occurred during the subsequent bearish pullback. If you haven't already noticed, this structure has now formed a bearish order block with an overlapping bearish fair value gap, making this our first example of a very high probability order block. The reason this setup is so strong is that the liquidity sweep signals the market's intended direction. And since the order block formed as a result of a respected PD array, it adds further confluence, supporting the bearish directional bias indicated by the market structure. To illustrate this further, let's look at another example where the market is moving within an uptrend structure. Let's look at another example. In this chart, the market is moving in an uptrend structure. Using the knowledge we've gained from previous videos on liquidity and fair value gaps, we know that for a bullish trend to continue, the market must consistently create and find support within bullish fair value gaps, like the one highlighted here. What's notable is that when we examine the move that pulled into and respected this fair value gap, it also formed a new bullish order block. This was confirmed by a break of structure during the next bullish leg. This gives us another strong example of a high probability order block, because it was formed within a move that respected another PD array, in this case, a bullish fair value gap. As we discussed earlier, in a trending market, fair value gaps tend to act as support zones. Here, a bullish fair value gap formed within the order block, reinforcing the support level and helping drive the next leg upward. The key takeaway: you should focus on order blocks that are formed as a result of another PD array, such as a liquidity sweep, a fair value gap, or even another order block. This not only confirms that the order block aligns with the market's directional bias, but also increases the strength and reliability of any overlapping PD arrays within that zone. This brings us to the next key step. You should only trade order blocks that align with the higher time frame market structure. In this example, we're looking at a 15-minute chart, where we can identify two valid order blocks, each having its own fair value gap. The problem, however, is that one is bullish and the other is bearish, meaning they conflict in directional bias. This is a common scenario that causes confusion for many traders. They're unsure which PD array is more likely to hold. That's why this serves as a perfect reminder of the importance of using top-down analysis. When we zoom out to the 4-hour chart to assess the broader market structure, we can clearly see the price action is forming a typical market maker-sell model. We first observe a liquidity sweep at the top, followed by a change of character, which signals that the directional bias has shifted to bearish. Now, with both timeframes side by side, we can see that the price action on the 15-minute chart is represented by the last candle formed on the 4-hour timeframe. With some deeper analysis, we can observe that this 4-hour candle rejected a bearish fair value gap, which was formed inside a 4-hour bearish order block. So, between the two 15-minute order blocks, the one more likely to be respected is the bearish order block, since it formed during a move that respected the higher timeframe bearish fair value gap, meaning it aligns with the larger market structure. And as we move forward in time, that's exactly what happens. The price pulls into the bearish order block and then makes a strong move downward, completely ignoring the bullish order block. That's it, traders. Thanks for watching. I hope you gained value from today's video. If you did, make sure to hit that like button. It truly helps support the channel. And if you're new here, consider subscribing so you never miss out on future content. Thanks for tuning in, and I'll catch you in the next episode.